Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. If you've experienced worry recently about your retirement savings or investment portfolio, you're not alone. When events in the world take on a dark tone and stock markets bounce around, it's easy for our minds to catastrophise. In this week's episode, I'll be addressing what this volatility means for you and how you should move forward. I hope you get some good value out of it. All right, let's dive in with this week's episode, Market Volatility, War, and Your Retirement Savings. I need to start by date stamping this one because events change quickly and there's a lag between me recording the episode and it finding its way into your ears. So I'm creating this episode on the 18th of March 2026, and at this moment the United States and Israel's conflict with Iran is continuing, with the implications for global energy markets having ripple effects around the world. Currently, investment markets are down a little, though not hugely so, on the assumption that this conflict will be short-lived. Let's hope that proves to be the case. However, even if by the time you're listening to this episode, the Iran conflict is beginning to fade in our memories, market disruptions will happen again. Only a year ago, markets fell sharply when Trump announced his tariff plans. Before that, it was Russia invading Ukraine. Not so long ago, it was the pandemic shutting down the world. Rather than this episode therefore being specifically about the war in Iran, think of it more as a framework for living through market disruptions in the future, whatever their source. As I mentioned in the introduction, if the recent market volatility and world events has led you to be worried about your investments or retirement savings, know that this is quite normal and reasonable. We all work hard for our money, and our retirement system is built on providing for ourselves via superannuation. There's also a natural human bias towards devoting greater emotional energy to potential negative issues than we'd devote to equivalent positive issues. In behavioural finance, this is known by the term loss aversion, and it's believed to stem from evolutionary instincts whereby bad things might kill us, whereas good things are merely pleasant. So bottom line, if you've been feeling a bit stressed, don't beat yourself up. What's important though is what you do next. As mentioned thus far, whilst investment markets have been a little bumpy, they actually haven't fallen very much. Frequently, however, such as we saw in the tariff incident mentioned earlier and also when Russia invaded Ukraine, markets can fall fairly sharply. The key thing to keep in mind during these periods is that this only matters if you sell. The market price shown is the price at which someone is prepared to buy your investments from you. Because of some stress in the world, the price they're willing to pay is less than it was weeks or months earlier. But that doesn't mean that you must accept the price they're offering. Provided you don't sell, market falls are of no lasting consequence. And of course, if you happen to be a buyer, maybe they're a positive opportunity. On top of this, your investment return comprises capital appreciation and income. When we're talking about shares, which is the main asset class where market volatility is felt, your income comes in the form of dividends. Typically, these dividends are quite resilient to market volatility. It's unlikely the conflict in Iran will meaningfully impact the profitability of Commonwealth Bank, CSL, Woolworths, or Telstra. What's more, most businesses don't pay out 100% of earnings as dividends. They always have a bit of a cushion. So even if total business profits are slightly impacted, they usually have the capacity to absorb this and keep shareholder dividends steady. Now, some companies no doubt will be impacted in a negative way. Maybe Qantas, for instance, might be hit if fuel prices remain high for an extended period. But that's why we diversify And using the guidance evidence-based investment philosophy ensures comprehensive diversification to handle these circumstances. Because, of course, while some companies might be harmed, others, Woodside Petroleum perhaps in the current instance, will be winners. Appropriate diversification will smooth the result out for us. If you're retired and living off your accumulated savings, then dividend and interest income might be a good start, but may not be enough to meet your living costs. In this instance, we'll have a cash reserve set aside for you as a key element of your strategy. This is known as a bucket strategy. It ensures that you always have a stable portion in your portfolio that you can live off where you need extra liquid cash and it's an inopportune time to sell any investments. Financial modelling can greatly assist through these periods as well. For those listening who are already guidance clients, you'll of course be aware that each year we update your projections so you have a good sense of your long-term outlook. Typically, when we initially create your strategy, we also run stress tests, with one being based on the assumption that returns are half what we would normally expect. The purpose of these stress tests is to understand your degree of resiliency. For many of our clients, our projections indicate their savings will last well beyond their 100th birthday. Armed with this information, you can hopefully sleep a lot easier at night during periods of volatility, recognising that worst case, the impact might be that instead of running out of money when you're 111, well, you're going to run out of money when you're 108. We know that investment markets experience negative returns roughly 1 in every 4 or 5 years. Market disruptions occur even more frequently, but usually they're sufficiently short-lived that by the end of the year, actually, we still get a positive investment return. None of us have a crystal ball, and I certainly have no idea as to whether recent volatility will get better or worse from here. But I do know that investment markets have produced by far the best return of any asset class over the past 100 plus years, and market disruptions have been a standard feature across this period of time. We will get through this current chapter and many more in the future. Of that, I have absolutely no doubt. Well, thanks for listening to another Financial Autonomy episode. Hopefully you're getting our Gaining Choice email every week, which will also give you up-to-date information on what's happening in markets. If you're not currently receiving that email, if you go to the guidance website and scroll down, you'll find somewhere where you can add yourself to the list to receive that. I'll be back in a fortnight's time, and Nick will be in your earbuds or car stereo or wherever it is that you consume our podcasts. He'll be back next week with another Wealth Builder episode. All right, bye for now.